If you want to make money in the stock market, it's not too difficult. All you got to do is buy low and sell high. The problem is, after you buy today, nobody knows if the market is going to be higher or lower tomorrow. And as you're trying to do your due diligence, you're trying to do your research, you're trying to make a smart investment, you're going to get very conflicting results and opinions about what's going on in the market. Just take a look. Yahoo Finance says that investors are warning that Omicron and the Federal Reserve Bank are a risk in the growing but slowing economy. CNBC says that wealthy investors want to own less of their investments because everything's in a bubble in 2022. And if we go back to Yahoo Finance, JP Morgan, the biggest bank in the world, says that investors are too bearish and there's no sell-off in sight. Let me just read you the first sentence of the article where JP Morgan Chase Bank says that there is no market crash coming and we are going to see the market boom in 2022. There is little reason to fear that the rally that catapulted the United States stock market to records in 2021 will end soon. JP Morgan Chase Bank says that in fact, it might get broader in 2022. Now, I know I said just a second ago that JP Morgan Chase Bank is the largest bank in the world. They are not the largest bank in the world, but they're up there. They're one of the largest banks in the world. And they say that we're going to see a continued stock market boom in 2022. That's great news if you're a stock market investor. If you are not a stock market investor, that could be good news or bad news. If you're putting your money into the market and you see a boom, that's good news. If you want to invest your money in the market, but you're not ready to, well, then a stock market boom is bad news, because that means that when you are ready to invest in the market, it might be a whole lot more expensive and cost you more dollars to go out and invest your money in the market. That's one of the side effects of inflation. Inflation makes your buying power less with the dollars that you have, and that also makes it harder for you to go out and invest money because assets, things like stocks and real estate, become more expensive because as you print more money, the value of each individual dollar goes down, causing the price of things, including assets like the stock market, to go up, because one of the places that people put their money to go and combat inflation is the stock market. But I'll talk about that in just a little bit. But going back to this article, it's very interesting to hear what JP Morgan Chase Bank thinks is going to happen. So let me go back to this, because they say that the conditions for a large sell-off are not in place right now, given already low investor positioning, record buybacks, limited systemic amplifiers, and positive January seasonals. So what they're saying is there are 4 reasons why you're not going to see a sell-off, why you're not going to see a crash in the stock market. The reason number 1 is you have low investor positioning. I talked about this in 2020. When you started to see the stock market rally, everybody was wondering, is the stock market rally going to last? And one of the things that I talked about is you have to look at investor positioning. Investor positioning is how much cash is sitting on the sideline. Because if investors are fully invested, if people have all their cash in the market, well, then there's no more ammo to boost the stock market up even higher, because the stock market is priced by supply and demand. When you have more buyers than sellers, this pushes the price of stocks up. Because if you are selling a stock for $10 a share and me and 10 other people want to buy your stock, and now we're bidding for the stock that you have, and now I have to offer $10.25 to buy your share, well, then that's going to push the price of stocks up, because you have more buyers than sellers. More buyers are bidding for the stock than people selling the stock. But if all the buyers are cashed out, they're tapped out, they have all their money in the market, and then you go and try to sell your stock for $10, well, none of us have any money to invest. I can't afford $10. So you might be forced to cut it to $9 to entice somebody to say, okay, I think I can round together $9 and go out and buy your stock. And so what this article is saying is you still have a lot of cash on the sidelines. And part of the reason for that is, well, one, we had all this inflation, we had all this low interest rates, so a lot of corporations, a lot of people have access to more dollars. You have a lot of people that are sitting on equity in their homes. A lot of people have been refinancing their homes and they have cash in the bank. You have people and institutions that were able to borrow large sums of money, millions of dollars at low interest rates. And this is now buying power. This is the ammunition. And they're saying that a lot of it is still sitting on the sideline. And so if this cash is just waiting there to be deployed, well, then there's more opportunity for the market to go up, as long as there are dollars waiting to be invested. Once all the money is invested, well, then that's when you can really start to see a market slow down, because then there's no more money left on the sideline. So that's what they say. The second thing that they talk about, make sure I don't miss it, are record buybacks. Stock buybacks were under a lot of criticism in the 2020 pandemic era, during the 2020 time, because we saw airlines that were doing massive buybacks before the pandemic hit. So you do a buyback because you have a lot of cash left. You have profit in your bank account. So your company makes a lot of money over the year, and now you could invest this money in more growth. You could save this money, but you don't want to do that. You don't have a way to invest it in more growth. You don't find that opportunity. You don't want to save it. Either you have savings or you don't want to save more money. So you want to put this money to work. You just don't know where. And so what a company will do then is they can either give this money to the shareholder in the form of a dividend, but then you're going to be taxed, because if I give you cash, it's income, or I can use this cash to go out and buy my own stock. And now if you have billions of dollars going to buy your own stock, like remember what I just said, supply and demand. You have more demand when you do a buyback. You have billions of dollars going to buy your own stock. This is going to push the price of stocks up. And so what we saw happen in 2021, later 2021 and going into 2022, you have a lot of companies with very high profits. And one of the reasons for this is because everybody was just buying things in later 2021 and now into 2022. People are just buying things. It doesn't matter if the price of things are going up. People are still spending money. They're spending money at record speeds because, well, some people are just tired of the pandemic, and some people were like, hey, I have some extra cash in the bank. I want to go and spend it. I have equity in my home. I want to go spend money. I'm not saying this is right. I'm saying this is just what's happening. So you have companies that are making money, even though their margins might not be as big as they were before, because they have higher costs of production, they have higher labor costs, and all these things going on. So they might have smaller margins, but they've been able to sell so much stuff because people just keep buying everything. And now a lot of companies are talking about doing buybacks. And so if they're doing buybacks, that means they're now taking this cash, they're not doing anything productive with it, they're not using this cash to build more manufacturing, they're not using this cash to invest in the future, they're not using this cash to innovate, they're using this cash to now just prop up the stock price. Now, this is great news if you are the investor in a company that's doing a buyback, but on a more economic level, buybacks don't have as much purpose. But now, again, who are we looking at? If we're talking about the investors, that's great because it's good for the stock market. This is why it pays to be financially educated, because when you're financially educated, you are the investor. You are the person that benefits when these things happen, so you want to be on the winning side. And JP Morgan Chase Bank says that we're going to see a lot of buybacks happen in 2022. That's going to help prop up the stock market. The third thing they talked about are limited systemic amplifiers. Sorry, I've been saying it wrong the whole time. I meant to say limited systematic amplifiers. English is my second language. That's my excuse. Anyways, limited systematic amplifiers. Now, I wasn't sure what that meant when the first time I heard that. I went to go search limited systematic amplifiers on Google and I got no results. But what I think they mean by limited systematic amplifiers are things that can amplify the problem. Things like maybe the pandemic, things like maybe more of the labor shortage, more of those type of amplifiers that can help these systematic problems that are going on with their economy. So I don't know for sure, so I'm not going to go too deep into that, but what they're saying is there are limited systematic amplifiers, and what I think is they have less of these systematic issues. The fourth thing that they talk about are positive January seasonals. So you have some companies in the stock market that are cyclical, some that are seasonal. A cyclical stock means it does well in a certain phase of the economy. When the economy is booming, that's when this company might do better than other times. So you could think of something like Gucci. Gucci does well when people have money. When the economy is doing better, it does better. Versus something like McDonald's, when the economy is not doing well, well then McDonald's actually benefits, because then people are more likely to go out and buy cheap food like McDonald's, maybe even Walmart. So that's what cyclical is, but seasonal is more of within 1 year. And what they're saying is they're seeing a lot of growth already in January 2022, where people are going out and spending money. And the way that our economy works is based on spending. The more money you spend, the more money somebody else makes. So if people are spending money at businesses, well, that means businesses are making bigger profits. If businesses are making bigger profits, well, that means the stock is probably going to do well, because then people are going to say, oh, I want to go out and invest in this company because it's making a bigger profit. So that's the way that it works. And if people are spending money, well, then the system can continue running this way until people stop spending money, or if people run out of money, then one of these two things fall out of whack, and that's when things come down, and that's when things have to correct. Now, this is where things get really interesting, because remember, JP Morgan Chase Bank obviously wants to see stocks go up because they're heavily invested into a lot of companies, and they want to see their own stock price go up. And so, they want to see companies go up. And they go on to say that they don't think that markets will be affected by the Federal Reserve Bank and interest rates. They think that people are over worried about the Fed, they're over worried about this pandemic, and because of that, they think that the stock market will continue to rally. They said that investor positioning is too bearish. The market has taken the hawkish central bank and bearish Omicron narratives too far. So what that means is people, investors, are taking the whole idea of the Federal Reserve Bank raising interest rates. That's what they mean by hawkish position. They're taking this idea of the Fed raising interest rates way too far, and they're taking the concerns of this pandemic way too far in the market. Too many people are bearish. Too many people think that the market's going to go down, and because of that, Chase Bank says that the market is actually going to boom. Because what they're saying is, once we get to that point where the Fed has to raise interest rates, they don't think it's going to be that bad. They don't think that when they raise interest rates, it's going to affect the market that much. And so when people realize that, it's going to create more boom, because people are going to say, oh, I thought the market was going to crash, but it didn't. So now let me go in and buy even more because I don't want to miss out on this rally. Same with the pandemic. They think it's overblown. They think that this virus concern is overblown. And because of that, once people realize this, it's going to cause the market to continue to boom. So now that we're here, the question that you have is, what does this mean for me and what should I be doing with my money? Well, what you do with your money is going to depend on what you think is going to happen. Either you can fall under one of these three categories, and how you invest your money is going to depend on what you think is going to happen. You can think that the market's going to grow. You can think that the market won't grow. Or you can think that the world is going to end, that we're going to see massive inflation, we're going to see a massive economic crash. So there's a lot of different ways that you can take this, and based off of that, there's different ways that you can invest your money, and there are ways for you to invest your money where you can benefit no matter what happens. So let's talk about that. If you think that the market's going to grow, you think the economy is going to continue to boom, you think the economy is going to lead to a stock market boom, if you think that, well, then what you want to be doing is investing your money in the market, right? If you think the market is going to be higher next year and the year after that and the year after that, it makes sense for you to go in and invest your money right now. Now, there's a couple of different ways that you can invest your money, and I'm not talking about trading because I'm not a trader. I'm talking about investing your money. You can invest your money the active way or the passive way. I do both. Now, the active way is you go out and you invest in individual companies. So maybe you like Tesla or Amazon or Apple or McDonald's or Domino's Pizza or Airbnb. You find a company that you like, then you go out and invest in it. But in order for you to actually succeed as an active investor, you have to do the research. That means you got to do the fundamental analysis. You want to be reading the cash flow statements. You want to be reading the profit and loss statements. You want to be listening to the earnings calls. You want to be paying attention to what products they're producing. You want to be paying attention to what they want to do in the future. You want to see, is this company creating a product that people are going to want 5 years from now, 10 years from now? If yes, is there something that people are going to want more next year than this year, or is the demand going to fall? And are revenues growing, or are they shrinking? Are profits growing, or are they shrinking? If they're growing, how fast are they growing? If the profits are shrinking, why are they shrinking? And a lot of times people assume that if profits are shrinking, that's automatically bad. That's not the case. Sometimes profit shrinking is bad because, well, the cost of doing a business is higher and people don't want the product as much. They don't like the product as much. Other times it could be they're taking more of their money and they're investing it in growth because they want to build more plants. They want to build more products. They want to invest in more innovation. In that case, that reason for profits going down is good. So you want to pay attention to all this. That's what fundamental analysis is. You want to go to a site. I like to use seekingalpha.com. You can use the free version or the paid version. You go into the free thing and you get to see all the information right there. You can read the earnings reports. You can see everything going on with the company. You can see the revenues, the profits. Learn to analyze the data. Then on the passive side, so if you find a company that you like, you want to make sure that it's not overvalued, you want to find a good price, then come in and buy. And remember, investing is when you hold on to it for the long term. That means at least a year. Going back to the passive side, Now, my passive strategy, this is just what I do. On the passive side, I invest in a few ETFs. An ETF is an exchange traded fund. It is a basket, a group of stocks. So instead of investing in an individual company, it invests into a group of companies because this is completely passive. So I have a system where every Wednesday, I have money that leaves my checking account and it automatically gets invested into a few different ETFs. I've already made a few different videos on ETFs and ETF investing on my channel. So if you wanted to watch those, you can go and watch those videos. But this strategy happens whether the market is up or whether the market is down. It does not matter. A passive strategy is something that's working to build wealth over the long term. So every week, every Wednesday, money is automatically being invested into these ETFs. So this is something that you don't have to research all the companies. All the fundamental analysis that I talked about here, you don't really have to do that here. On the passive side, you just find a few ETFs that give you exposure to the industries or the markets that you want to get exposure to, and they have all the companies in there. So you just fund the ETFs, and you're just going to invest in it for the long term, and you just keep consistently investing your money. So this is happening whether the market is up or down. Does not matter. You're going to continue to keep doing that. This, I'll wait for a good opportunity. I'm not going to overpay here. That means I'm still being picky. This will also apply here on the market won't grow side. But if you're actively investing in companies, the key is you don't want to overpay. You don't want to chase stocks. And so what that means is you want to make sure you're buying something that you believe is a good value, that we can hold on to it for the long term. But in order for this to work, again, you're not trying to time the market. So there's a difference between trying to time the market and overpaying for a company. Timing the market means I am going to wait for a market crash. When the market crashes, that's when I'm going to come in to buy. So you're not trying to wait for a crash because no one knows when the crash is going to happen. And the people, it's kind of funny how this works. The people that say I'm going to wait for a crash to buy, when they do see a crash, they end up not buying because now it's like trying to catch, trying to catch a falling knife, because what you're trying to do is you're trying to catch it at the bottom. But you don't know when the bottom is going to be. I saw this happen in the 2020 pandemic because, when the 2020 pandemic hit, the market started crashing. And so I started making videos every day about what was going on in the market. And I talked about how I had this rule that if I see a company that I like and it falls by 10%, I'm going to come in and buy it. Every 10% it goes down, I'm buying more aggressively. So I'm just buying on the way down because I don't know how far down it's going to go. Maybe it comes down this far, maybe it comes down this far. I'm just buying it all the way down, and the further down it goes, the more aggressively that I'm buying. So I know what I like and I know what I want to buy. I'm just waiting for it to go down to get a good price, and that's when I buy. But then you have the people that say, no, I want to buy it at the bottom. I'm just going to keep waiting. And then you keep waiting and waiting and waiting, and then it just starts to turn around, and you say, oh no, I'm not going to buy it now. It's starting to turn around. I want it to go down even further. But then it just keeps going up and up and up, and that's when everybody kept saying, no, it's overpriced. It's just going to come back around. And then they missed it, and then they kept going higher and higher and higher, and now it's where it was before the pandemic, and then everyone said, no, I'm not buying it now. Now it's overpriced. And it went higher and higher and higher, and then they missed the opportunity. So that's why you do not want to be trying to time the market, because when you try to time the market, you don't know how long you're going to be waiting. You're going to miss on the upside, and then when it does come down, you're probably not even going to be able to pull the trigger because you're going to be waiting for that perfect opportunity, and that perfect opportunity will never come. That's why what I like to do is I like to look for the opportunity where I'm investing in a company that I believe is a good price. So that's active versus passive. Now, if you do want to learn more about how to analyze companies, fundamentally you want to learn how to invest your money, we have something called Market Insiders. It's a company that I created. Market Insiders will allow you to get weekly market coaching. So this is for the stock market and the real estate market. We're also adding in cryptocurrency coaching. So every week you get access to coaching calls from our amazing coaches. These are real investors, coaches that have been investing for years. They have hundreds of thousands, if not millions of dollars in the market. And every week you get access to their coaching lessons where you will learn a new lesson. And then you will learn how to apply what they learned to what's going on in the market, because all their classes are live. So if the Federal Reserve Bank raises interest rates, well, they'll talk about how that affects the market. So if you want to try out Market Insiders, I'll give you access to a free 10-day trial where you can go through everything. You can go through the free classes. You can go through the previous recordings. You can attend the coaching calls. You can chat in our private Discord. If you want to try it out, it's a free 10-day trial. There's no commitment required. You can try it out, see if you like it. If you like it, then you can continue. If you don't like it, well, it's not going to cost you a penny. So try it out, Market Insiders. I'll put it for you in the description. And then you have number 2. The people who think that the market will not grow. So if you think that the market will not grow, then what you want to be doing is investing your money into companies that are not reliant on the market. So what I mean by that is if you look at some of the larger blue chip value companies, they rely on what's going on in the economy. If the economy is growing fast, well, then these larger blue chip companies will be able to grow faster because the economy is growing faster. You can think of it kind of like trying to push a massive wheel. If you have this big, massive, heavy wheel and you're trying to push it, well, it's going to be a lot harder to push that than a smaller wheel, right? A smaller wheel is easier to push, it's easier to grow, it can make more turns, it can be more nimble. The United States is very large, along with some of our large companies, our blue chip companies. And so for them to grow much bigger is harder because they're already so large. They can't be as nimble. They can't make these more innovative steps as fast. And so if you think that our economy is not going to grow as fast, that means you probably think that these big companies are not going to grow as fast. And if they're not going to be able to grow as fast, well, then you're not going to get the same return. So then what you should be doing is looking at some of the smaller ones, looking at the more innovative companies, trying to invest in innovation because these are the companies that are scrappy, that are trying to get more market share. They're trying to be one of the big wheels. They're trying to get bigger. So if you don't think that the market or the economy is going to grow as fast, then you don't want to put all of your money into just ETFs or companies that are reliant on the big economic growth. So this would be like the S&P 500 fund, the S&P 500 ETF, things like VOO, SPY. Quick disclaimer, I do have some of my own money invested in VOO. If you don't think the market's going to grow or the economy is going to grow, well, then you're not going to see the best return with those type of ETFs. You should be investing in more innovative companies, more innovative ETFs. I also have money invested in innovation ETFs, and I also invest in innovative companies. So you got to kind of figure out, okay, if you think the market's not going to grow, well, then you want to make your decisions accordingly. So I invest this way and this way because I don't know what's going to happen. So I like to invest here and here, but this is where investing in innovation can give you more potential upside, but it also comes with more risk because now you could see some of your stocks go away. They can just completely disappear or die because, well, they're smaller. So they have a higher chance of failing, but it also comes with more opportunity. Now, I actually really enjoy this because I like investing in the more innovative type of stuff. I like researching the smaller companies. I like looking for those growth opportunities. And I think, younger people have more experience with that because you've seen the growth in technology. You've seen technology just change everything that we do, from our money with cryptocurrency to the way that we get a car, to the way that we get a hotel, to the way that we get a mortgage. So we're seeing technology change, and it gives you opportunity here if you can find a younger, scrappy company and you buy it in its early stages. Then you have the opinion that the world is going to end. We're going to see the economy crash, the dollar crash. What do you do then? Well, then this is where you can invest in things like gold and Bitcoin. Now, obviously, you can invest in gold and Bitcoin, or just gold, depending on what your opinions are. But I want to talk about gold and Bitcoin, and I invest in both physical gold and Bitcoin. These are hedges. Gold is a hedge against inflation because if, hypothetically, the dollar collapsed, a US dollar goes to hyperinflation, the dollar becomes worthless, well, then people are going to look for something else that has value. And one of the things they could go to is gold or Bitcoin. But let me focus on gold right now. Gold is a store of value because it takes time, effort, and labor to mine an ounce of gold. And so that intrinsic value of gold is the effort that it takes to produce that gold, right? If I go out and I mine gold, well, the ounce of gold, the value in it is the effort that it took to produce it. And there's also a limited supply of gold. So because of that, there's intrinsic value in gold. And that's why gold has been a commodity that has been used as a currency for centuries. It's used as a currency because compared to other commodities like oil or water or wheat, it's much more accessible to transport and transact with. I mean, could you imagine making transactions with wheat? Well, it's not as easy with gold, but still, gold is not as easy as dollars. And so in this case, if you're worried about the dollar collapsing, you're worried about the economy, well then gold can provide you as a hedge. Now, I own physical gold. I look at it like real money. I don't really care what happens to the price of gold. I know that the price of gold hasn't seen that much growth over the last decade. But for me, it's more like insurance. It is a fallback. Like if everything else were to go wrong, I have my gold. It is another way to save your money and earn something, hopefully, compared to the money that you're going to get in your savings account. But again, I don't really care what happens to the price of gold. It's just something that I own because it is real money. Then you have Bitcoin. Bitcoin is kind of like the digital gold. I also own Bitcoin. This is, a lot more speculative than gold because we've seen gold tested through centuries. Bitcoin is much newer, but there's a limited supply of Bitcoin, and the value in Bitcoin kind of comes the same way as gold because in Bitcoin, it takes effort to mine Bitcoin. It takes computing power, electricity, energy, and so that energy, that value of that is then seen through the value of one Bitcoin. Now, the difference between Bitcoin and gold is used in the physical world. Bitcoin is used in the digital world. You can use gold in jewelry and aerospace and other technologies. In Bitcoin, everything is done in the digital world. So there's a difference in use in Bitcoin and gold. But if you believe in Bitcoin and you start to see more adoption of Bitcoin and more people start to use Bitcoin, well, then you would see the value of Bitcoin go up. And the thing that makes Bitcoin similar to gold in that sense is that you have a limited supply of Bitcoin. There are 21 million Bitcoins potentially out there, and that's it. You cannot produce or mine any more Bitcoins. So if you have a limited supply of Bitcoin and more people want to use Bitcoin or they want to store their savings in Bitcoin, well, that would ultimately make the price of Bitcoin go up. So over time, you would imagine that if more and more people save their money in Bitcoin, well, then that would make Bitcoin more valuable, and that could be a hedge. So, it doesn't have to be a world's going to end type of thing. This could also be something where you want to invest in the future. It's a little bit speculative, but if you want to invest in the future, that's where you can also invest your money. But now, based off of what you think is going to happen in the world, that's how you want to be investing your money. Because what most people do is they go in and they say, okay, I want to invest my money. Fine, what's my strategy? I want to invest in a hot company and hope I make some money. That is not a strategy. You need to know what your beliefs are. Based off your beliefs, that's how you invest your money. I invest actively. I invest passively. I invest in innovation. I also own some physical gold. I also own some Bitcoin. I don't know what's going to happen, but I know that I want to invest in different places because I want to see growth in the market. That's why I invest here. I also want to invest in innovation because I enjoy that. That's why I invest here. I want to have some insurance. That's why I invest here. I think that we're going to see a change in the way that we use money. That's why I invest here. So there's not a one-size-fits-all strategy when it comes to investing. My goal is to help you be financially educated. That way you can pick the best strategy for you. That way you can make more educated financial investing decisions. We have had pretty much no production of products in 2020 and 2021. And then in 2021, towards the second half of 2021, we saw a massive demand in products because everybody started now to go back to the real world after the pandemic started to go away. And so we saw this massive demand from people wanting to buy stuff and we had no supply. And so this created a really weird shift in the economy.